Hello and welcome back to Deceit here. This video is the last in the mini-series of financial scandals. So in this one, I would like to talk about a scandal that has affected hundreds and thousands of people over the decades all over the globe. I'm talking about the infamous Ponzi schemes. A Ponzi scheme is a form of investment fraud in which an operator of the scheme pays returns on investments from capital received from new investors rather than from legitimate investment profits. Ponzi schemes are named after Charles Ponzi, who in the 1920s promised investors a 50% return on investments in postal coupons. Ponzi used funds from new investors to pay fake returns to earlier investors. Ponzi schemes often promise high returns with little or no risk. They may also target vulnerable populations such as elderly or people with disabilities. The biggest Ponzi scheme ever was perpetrated by Bernie Madoff. Madoff was a respected investment advisor who ran a massive Ponzi scheme for decades. He promised investors high returns but used their money to pay off earlier investors. When the scheme collapsed in 2008, it was the largest Ponzi scheme in history, with losses estimated at $65 billion. Bernie Madoff was born in New York in 1938. He started his career as a stockbroker in 1960 and founded his firm Bernard Madoff Investment Securities in 1964. His firm was successful and he became a respected figure in the financial industry. He served as chairman of the Nasdaq Stock Exchange from 1990 to 1993. In the early 1980s, Madoff began to run a Ponzi scheme out of his investment firm. He promised investors high returns, often around 10% per year, regardless of market conditions. Madoff was able to maintain the illusion of profitability by falsifying account statements and creating fake investment portfolios. His scheme was able to operate for so long because he was a trusted figure in the financial industry. He was also able to attract investors by offering high returns with little or no risk. His victims included individuals, charities, and other financial institutions. The collapse of Madoff's Ponzi scheme had a devastating impact on his victims. Many people lost their life savings and retirement funds. The scandal also damaged public trust in the financial system. Madoff was arrested in December 2008 and pleaded guilty to 11 crimes, including securities fraud and money laundering. He was sentenced to 150 years in prison in 2009. He died in prison in 2021. The Madoff Ponzi scheme was the largest in history, and it led to several new regulations being introduced to prevent similar fraud from happening in the future. One of the most significant changes was the Dodd-Frank Wall Street Reform and Consumer Protection Act, which was passed in 2010. The Dodd-Frank Act created many new agencies and regulations to oversee the financial industry, including the Financial Stability Oversight Council, the Consumer Financial Protection Bureau, and the Securities and Exchange Commission, or SEC. The Dodd-Frank Act also introduced some new rules specific to investment advisors, including the fiduciary rule. This rule requires investment advisors to act in the best interests of their clients. It means that advisors must put their clients' interests ahead of their own and avoid conflicts of interest. The Investment Advisor Registration Rule. This requires investment advisors to register with the SEC. This registration process helps to ensure that investment advisors are qualified and meet certain standards of conduct. the Investment Advisor Examination Rule. Now, this rule requires the SEC to conduct regular examination of investment advisors. These examinations help to identify and prevent fraud. In addition to the Dodd-Frank Act, some other regulations were introduced after the Madoff Ponzi scheme. For example, the SEC introduced a new rule that requires investment advisors to disclose more information about their fees and conflicts of interest. The SEC also created a new office to focus on investment advisor fraud. The regulations introduced after the Madoff Ponzi scheme have made it more difficult for investment advisors to commit fraud. However, it is important to remember that no regulation can eliminate the risk of fraud. Investors should always do their research on investment advisors before investing any money. The Madoff Ponzi scheme scandal is a cautionary tale and several lessons can be learned from it. Here are a few. Number 1. Be wary of investment opportunities that promise high returns with little or no risk. There is no such thing as a free lunch. And if an investment sounds too good to be true, it probably is. Number 2, do your research on investment advisors and companies before investing any money. Check with your state securities regulator to see if the investment advisor is registered and has any disciplinary history. You can also read online reviews and complaints about the advisor. Number 3, be suspicious of unsolicited investment offers. If you receive any unsolicited investment offer, be wary. Legitimate investment advisors will not contact you out of the blue. Number 4, never give out personal or financial information to someone you do not know or trust. This includes your government ID number, bank account number, and credit card number. Number 5, monitor your investment accounts regularly for suspicious activity. Look for unauthorized withdrawals or changes to your account information. If you suspect that you may have been a victim of investment fraud, you should contact your securities regulator immediately. In addition to the lessons listed above, the Madoff Ponzi scheme scandal also highlighted the importance of investor education and financial literacy. Investors need to be aware of the risks involved in investing and how to protect themselves from fraud. Thank you for joining us for the final video of our Financial Scandals mini-series here on Vitsikya. The story of Ponzi schemes, particularly the infamous case of Bernie Madoff, serves as a stark reminder of the importance of vigilance and education in the world of finance. In the wake of the Madoff Ponzi scheme, significant regulations were put in place to safeguard investors. However, it is essential to remember that no regulation can eliminate the risk of fraud. Therefore, it's our collective responsibility to remain vigilant and well-informed when navigating the complex world of finance. Thank you for joining us on this journey through the world of financial scandals. We hope this mini-series has provided you with valuable insights to protect yourself and your investments. Stay informed, stay cautious, and always make well-informed financial decisions. If you have any questions or would like to share your thoughts on this series or any related topics, please feel free to do so in the comments below. We look forward to engaging with you in our future videos here on Vitsikya. Until then, take care and stay financially savvy.